Thank you, Farheen. All right, guys, I know I have the late afternoon spot on a Friday, but I want everybody to just stand up. Let's get some energy and let's get some oxygen. Stand up, stretch up. There you go. Lean over. All right, see, you feel better already. It's Friday. It's going to be a great weekend. Okay, now everyone can sit down. You got some oxygen going. So again, my name is Ron Rohde. I'm a former attorney, now very much into the crypto space, luckily, fortuitously through mining. My partners and I have been mining around since 2015, just kind of casually, and then we would mine and sell. So it's very interesting, what he commented, that nobody was a visionary to predict that the price would explode as it has. All right, so this is a quick outline. We're going to talk about what is mining and try to get to a little bit of a technical definition. Who is mining? Everybody hears that China is mining, but what does that really mean? What's the incentive? Different types of mining. You may have heard of ASICs or GPUs or CPUs. There's a lot of different modes there. Real estate or hosting, scale, the current state of mining, and some future predictions that maybe can have real-world implications for you. All right, so what is mining? Very broadly, it is the method of the decentralization of the network. So mining requires people to use energy to confirm blocks written on the blockchain. And so these computers are providing two functions: confirmation of transactions, and then they also receive new coin issuance. So between those two payout methods, so for example, Bitcoin, that's a SHA-256 algorithm. They are mining, and there's a limit. When they reach the 21 million coins, there will be no more issuance of new, quote unquote, new Bitcoin. And so only miners, the transactions that they will receive are for processing transfers within the existing framework. We have the ASICs. The ASICs evolved as a specialized chip. In the beginning, you could use just normal GPUs, which is a graphics processing unit, and that's like a video card for gamers. You could use that to mine Bitcoin, but they've built these specialized chips that only mine the SHA-256 algorithm, and they've been wildly successful and more competitive than the traditional GPU. However, there are coins that are ASIC resistant, or that still have profitability, and they're ASIC resistant, so you can't mine it with the specialized chips, and you still use graphics processing units. Ultimately, you're utilizing energy to provide a valuable service, and everyone sees all those big shocking headlines. Okay, power a house and mine 1 Bitcoin. But on the flip side, the analysis is how much does it cost to support our current infrastructure of banking? How much does it cost to keep the lights on at bank branches and their server rooms and their data centers and their phone calls? So there really is a huge cost to supporting our existing financial network, and the mining is a different way of solving that problem. Who is mining? So the initial concept in Satoshi Nakamoto's very first paper is to decentralize this ability. The miners are spread out throughout the world. All you need is a simple internet connection and electricity, and you'll be able to support the network. You'll have access to the full blockchain. You can see all the transactions, and you can support the network wherever you are. What we've found is that's not really the case. People talk about China is mining everything, and that there are different ways you can measure that. Who has the most number of ASICs? Who has the total hash power? And that's probably the best measurement of who's doing the most mining. But China is by far the dominant player in terms of now they own so many of the machines, both GPUs and ASICs, and now they're spreading out, and they own and control that hash power in different countries. So you can see, just as an example, Iceland is very popular, Canada, and there are these other countries that are becoming more popular, but it's going to be harder to track who quote unquote controls the mining when they're placing it in, and their IP addresses in different countries. So let's see. These are some sample GPU setups. You know, these are pretty simple cards. And this is a home setup. It's something that everybody in this room could do in, you know, their basement or in a sunroom. And I think that's really the appeal. And hopefully I can give you guys a little bit of education. Is this something that you're interested in? Because the economics work. You receive a profit of crypto in exchange for, you know, paying for the hardware and paying for electricity. And so is it worth it for everybody in this room to go out and buy a card and start mining themselves? And so we'll take a look at that later, and the answer is maybe. Yeah. Okay, so this is a sample rig that we use. So we have a small company that, you know, has been mining using investors and kind of expanding throughout last year. So I actually brought this sample rig that you can see pictured there on the right. And so it's in the back. I'll stick around if you guys have any questions, you want to look at it. It's 4 1080 Ti's. You know, these are off-the-shelf video cards powered with normal computer equipment. We use a motherboard. We use some specialized mining software, and then we're running the operating system as Linux. So the whole package is relatively simple. And you know, you build these yourselves. We have kind of like a workshop area, but by all means, anybody can run a computer of that size in their own home or office. Again, you know, these are just some photos. We accumulate these boxes. So types of mining, this is an ASIC, and the ASIC is kind of like about a shoebox size. And this shoebox is a collection of chips that only run one specific purpose. And the difference, the main difference between GPUs and ASICs is their salvage value or residual. So with a graphics card, if Ethereum and all of the altcoins go to zero, you still have a computer at the end of the day. There's a residual value you can sell to gamers. You can use it as a normal computer. There is a value in all of the parts that you buy to assemble a GPU miner. Whereas with an ASIC, you have a very expensive paperweight because it is a very, very specific tool that does one thing. And if Bitcoin goes to zero, you know, presumably there's no value in mining that Bitcoin. CPU mining, I'll talk about that briefly. That's a very small assortment of coins use CPU mining. It basically utilizes the different types of processing. A CPU is able to do sequential processing, whereas GPUs, the video cards, do a lot of parallel processing. It's pretty minor. You know, I think that people do dual mining. You can do some other things. It's just another option, but doesn't have quite the range of coins that you can mine as GPU. So, real estate or hosting. This is another big important part of the equation. Is for these large-scale miners or even people individually, where do you host the machines, and how do you provide adequate ventilation for them? So you have, you know, a huge cost-benefit analysis, a calculus that you have to start to factor in real estate. And this photo is from a purpose-built building in the Gigapod company out of Washington State. It's near hydroelectric power, so it's very cheap. Their natural temperature is pretty cool, and so they've chosen it as a very good place to expand. And they're building on, you know, several acres of land. Got another photo. They have a bank of, you know, ventilation fans, and that's the kind of scale that a lot of the miners are moving towards. So it'll be very interesting to see how institutional money is going to approach this. As every day that goes by and Bitcoin stays stable, you know, whether it's at 10 or 11 or 12, there's a lot of profit to be made in mining on a large scale, and that's where large institutional investors are going to want to invest. So there are a lot of economies of scale. You can see it with the real estate, you can see it with maintenance, and then as far as purchasing the inputs, you can get a lot of discounts. So, roughly in terms of price, we're talking 6 cents a kilowatt hours, maybe commercial price or retail pricing. If you just go online, power to choose. In Texas, we're fairly competitive globally at 4 cents for commercial rates. You can even do some things to do rolling capacity to reduce that. But that is competitive on a national scale, and I really think that Texas has the opportunity to be a crypto destination competing with some of the lowest cost energy providers in the world. A little bit more cost-benefit analysis. I'll run into some very specific details that you could potentially buy today. So let's talk about an S9. This is a machine produced by Bitmain. It's a company in China. You can buy one, I believe, anywhere between $2,000 to $4,000 for one machine. And that can or can't include the power supply, which is another few $100s. If you buy that machine, you take it home, you plug it in, you plug the Ethernet cable in, you're running about $75 a month for electricity. Now, how much Bitcoin you produce or you earn is a function of two things, is the mining difficulty and the value of Bitcoin. So if Bitcoin tanks, you still earn the same number of Bitcoin, but the value might drop below $75, maybe below $100. It's not, quote, worth it to run your machine and incur those costs. And I'm kind of ignoring the return on your investment, but that's your break even. And so you really have to calculate what you predict the price of Bitcoin will be. And it doesn't rely on Bitcoin increasing, but it should at least be stable. And so, as part of this analysis, a lot of people will create different scenarios where they say Bitcoin goes up, Bitcoin stays flat, or Bitcoin goes down, or Bitcoin, tanks. And with these different scenarios, you should be able to analyze what you think is going to happen. Make predictions about the value of Bitcoin. Make predictions about the mining difficulty, because that's what determines the piece of the pie, so to speak, that you earn, is the mining difficulty. It's solely a function of mining difficulty. And then from there, you decide what's your payback period. So if you're only gross revenue, let's say your gross earning $100 is your worst case scenario, you're only earning $25 a month. That is a pretty low return for maybe a $2,000 investment. It's going to take you a long time to pay that back. Whereas on the other hand, the GPUs, you have an initial cost, which is somewhat constrained by artificial demand in the market and a lack of supply for a lot of the high-end video cards. But not only do you have to buy the card, you have to buy the accessories. You have to buy a matching power supply, you have to buy the motherboard, the RAM, the CPU. You need to plug it all together and make sure it works. Then you still have the same electricity costs, the same internet, a little bit more maintenance maybe because they tend to crash more often and they go down. But then you have a residual salvage value. And that's a big difference when we're doing our cost-benefit analysis. Is for GPU miners, you have a basis. You have a electronic equipment that has a value that you can sell if all of crypto goes to zero, which I think there's a non-zero chance of that happening. And so GPU mining is nice that it has a little bit of that basis. So you can decide if you're a gambler and you want to buy an S9, or if you want some hedging and you want to do a GPU. So I really I'm open to questions. I think that I've tried to tailor this as kind of a general intro. Happy to do more technical questions or predictions. So. So his question was the mining pools. I kind of skipped over that part. Mining pools are how you connect your actual rig to the blockchain. They provide the mechanism to pool everybody's mining power, and then when the pool mines a block, they distribute the reward pro rata based on your mining. And so his question was, are there mining pools that are using futures contracts to hedge basically their currency risk? And the answer to the question, I don't know, but it would be a good, possibility where they can have some assurances. But some of the difficulty is they can't guarantee the production of the currency that's not their own. So theoretically, you could be on the hook for a future that you don't have the supply because 80%, 90% of your production is other people, and you can't control. So I think they have to take that risk into consideration.
Do you, in your ROI between ASICs and GPUs, do you take into account forks, airdrops? Because obviously, if you've been mining Bitcoin, you also get Bitcoin Cash, Bitcoin Gold, Bitcoin Diamond, and all the other 100 forks that nobody knows about. And then in the GPU side, with Litecoin, you now have Litecoin Cash, and then there's airdrops, Amiso Go, and then you have a number of things that people don't even know that they have.
Yeah. So his question. Your personal preferences are if you want to gamble. So I think with the S9s in particular, you have a lot of risks that we're seeing global mining difficulty increase without a huge or a corresponding number of S9s being shipped. And so what that tells me is there are new miners that are not for retail consumption. So either the Halong miners or maybe a new S11 or S whatever. And so if Bitmain is doing that, you're buying, older technology that you have to price into. So it really, you just got to pencil it out and look at the risk and decide which scenario do you think is more likely. And, all of this is a countervalence to, if you believe in Bitcoin, why not just buy Bitcoin directly? And you'll get all the gain from appreciation. So mining is a very different mentality. It's much more like dollar cost averaging. It's an investment with bond-like attributes because you put your money up front and then you get a monthly payback thereafter. Whereas buying Bitcoin directly is like an equity. You buy the stock and you get 100% of gain and 100% of loss. So it really depends on what your risk appetite looks like and what you...
So there's a huge shortage of GPUs right now, and there's a speculation that it's because NVIDIA is coming out with new chips.
The Volta, yeah.
The new line of graphics. So where do you see the new generation of chips? Do you think people should wait, or should they be buying graphics chips today, or graphics cards today at inflated prices?
Yeah, so we're definitely very interested in the new line. NVIDIA, has planned the new is like Q2 or Q3 release of the Volta line. It's going to be a very powerful new graphics card. We're a little bit cautious because of the words. They're trying to temper the miners' usage, and they're trying to say, well, we're going to limit cards. Some cards are for gamers, and some are for miners to try to separate that demand. I don't see practically how they can do that. It's not going to be possible. So if you're looking now, I think if you can independently determine a price that you're willing to pay for a certain card, that's how you should approach it, right? If somebody wants to give me old technology, I'm indifferent if it's at the right price. And I put a severe discount factor on the residual value, which may be zero. Same for 1080 Ti's. We tend to buy the biggest and the best now, and then we're going to cycle into the new Voltas when they come out buy a small batch, test them, see really what their hash is, and then determine how we want to shift resources into it or sell. So great question in the back.
What happens to the miners when the last Bitcoin is mined?
Right. So I kind of briefly mentioned there's two sources of revenue for the ASICs or for Bitcoin miners. It's production of new coins and then transaction fees. So after the last coin is mined, the miners will still be compensated by supporting the network and process. So everyone's transaction fees will go to the miners then.
But it will reduce the market.
Yeah, so again, it's kind of a function, the mining difficulty. So if people drop off or machines become obsolete or not used, then potentially the mining difficulty can go down, which means a higher share to a smaller pool. A smaller pool rewards to a smaller group of miners. Maybe it'll still be profitable, but yeah. Right. So you said investing in a mining pool is a bet on the coin. Do you mean like a mining contract, or you're actually? Investing in a mining rig. Yeah. That's pretty much the same as betting that the price is going to be relatively flat next year. Yeah, I would agree with that statement, or even low. It's a hedge against the value decreasing because you're still going to mine and dollar cost average as it's going down. But in the same way that spending $10,000 on a mining rig versus $10,000 in Bitcoin, if Bitcoin goes up, you see an outsized return, but maybe you only get 70% of the return, and the same is on a down. So if it goes down, you'll be exposed to maybe 60% of the down. Yeah, I think we have one last question.
So whenever the last Bitcoin is mined and miners are only making fees off of transaction fees, do you think there will be another transaction fee spike like we saw in December?
Possibly. I mean, I think the prior presenter had a good theory about Bitcoin moving to a store of value, and you have fewer transactions. And what that's going to do is it's going to push a lot of miners offline who have a higher cost of production. And again, I kind of briefly touched about the institutional, but if more miners become centralized and have the lowest cost of production, they're going to keep moving the miners to seek out the lowest cost of electricity. And as the miners in higher cost jurisdictions drop off, you're going to see a reduction in the share. So we might not see an increase in transaction price because the number of miners has decreased so rapidly because they can't compete and it's not profitable. So there will always be a balance, yeah.
That will be 122 years from now.
Yeah.
21.
Right. At current but mining could go up, so. All right, thank you guys so much. I'll be sticking around in the back.